Viral Berawala is joining us now to talk more about markets. Viral, how's your portfolio looking right now? In terms of valuations, how's your portfolio looking? Not the stock price movement, I mean, is something we can't really comment about, but did you see the valuation of your own portfolio also run up quite a lot?
Yeah, sure. So maybe I'll talk on the market valuations and then we'll go to the Buoyant portfolio. So, right now the market, even despite today's fall, is in an inverted pyramid situation where small caps are more expensive than mid caps and mid caps are more expensive than large caps. Nifty is trading at maybe 23 times trailing and less than 20 times forward, which is expensive than its average, but it's not like, one or two standard deviations. So it's slightly more expensive. But mid and small caps are, at 24, 26 times forward valuations, which are expensive. So what we have done with the portfolio is that during March, due to the taxation changes, you had an opportunity to invest in small caps. So we were like 50% plus in small caps. So we have reduced the exposure over last 2 months, and now maybe small caps are less than 35% of the portfolio. And the overall portfolio valuation also, we are sort of more like tracking Nifty rather than being in mid and small cap range. So there are select pockets still in small caps, but very, very select.
So, what parts of the large cap actually look appealing to you on valuation terms?
So, three broad parts, right? One is banks, second is insurance, and third is staples. So in banks, leading private sector banks have underperformed hugely. And we think at some point of time, there'll be some sort of valuation catch up. Maybe that's the only part of the market, which is trading at its average valuation. And we will still see double-digit growth at least for the next 3 years in almost the entire leading private sector bank market. The sort of cost of funds have gone up, but the margins, they've been able to maintain margins over last couple of quarters, and we think that will stay. Fee income will go up a lot, and due to capital market doing what they are doing, we think we can actually see upside to the fee income in banks. And the second part is insurance, right? After the budget, there were fears of steep decline in new business premiums because over 5 lakhs, the taxation in March. April, May was subdued, but again, the last 3 months, monthly numbers have been good. Secondly, what's happening in a lot of our insurance companies is that operating leverage has started to kick in. And we'll see the new business margins going up, one, because of operating leverage, and also because the product profile continues to improve, right? ULIP continues to go down, and ULIP was actually the big part of the 5 lakh plus ticket size. So ULIP continues to go down, and more term and guarantees get sold, which is much higher than average. Again, valuations are above average, slightly above there. So you get, a sector which is growing again in mid-teens, available at a price to EV of maybe, depending on what stock you take, but between 1.5 to 3 times. And the last part is staples. So staples, what's happened is that there has been annualization of price cuts, right? And the lower input cost is helping. Plus, we are seeing decent volume growth. Some sort of rural might be a little slow, but that is probably in the price. And we'll probably see the highest EBITDA growth since 2021. So staples is one place we are now looking at.
Right. Let's talk about staples a little more. What are those signs which will tell you that things have turned around fully for staples?
So what tells us is, of course, if one would be a good monsoon or a good festive season, right? We need to see volume growth. See, the sector over the last whole decade, right, starting from 2011 onwards, has been able to consistently take margin increases. And they have been able to maintain prices. It's been cyclical. There have been a few bad quarters in between. But if you look at the long-term trend, we are not worried on the margins. So in staple, the key thing to watch out is volumes. Are we seeing volume growth? And if the volume growth can go to, a sizable 6-7% plus 4-5% of price inflation, then we'll start seeing double-digit growth in the staple. So the key trigger to watch out in staples is volume.
Viral, how are you analyzing the demerger of Jio Financial from Reliance, and what Jio Financial is likely to create an impact on the lending side whether it will impact Bajaj Finance or not. I mean, in fact, Bajaj Finance just yesterday did indicate that market will not be disrupted by Jio Financials. In fact, Bajaj Finance, as per our sources, now wants to go into new areas of car loan and even MSME.
So one, of course, all of us know the market is very large. Second, the NBFC sort of market is, there are very few large players. It's a very diversified market. So Geo, what happens is that it will take some time. It won't happen in a hurry. They have got a balance sheet, one. Second, with the valuation that it is trading at, it's probably a Nifty company, within 6 months once they go into F&O. So, and then what happens is then it start getting more and more. Even if they want to raise funds, they will be able to raise it well. So Geo will take time. I mean, generally, service businesses, unlike a manufacturing business, where if you do capex and you suddenly have a large plant going on, that generally doesn't happen in a service business. So unless they acquire, if they go out and acquire, then they can probably disrupt. But that doesn't seem to be the way right now. We'll see a step by step, first a team coming in place, hopefully a very good team, and from there we'll see growth happening.
Viral, in banks, I mean, on the one side there are PSU which peaked out 6 months back, the likes of SBI and few others, and then have been sideways since then. The quality of the numbers have not deteriorated at all. And then there are names like, very demonstrable growth kind of names, ICICI Access. ICICI, there is a extension of the term of Mr. Bakshi as well. Which side would you prefer?
So I would prefer the private banks, as I said. So in PSU banks, the sort of risk is that the margins might get compressed. If the interest rates stay higher for longer, then the margin pressure on PSU banks is likely going to be higher. Second, right now, everyone is having a very good book. The non-performing assets are lower. But again, it's a cycle, right? If interest rates stay higher, at least some of the leveraged corporates will again start getting under pressure. And we might see some amount of slippages going up. Not to historic levels, but from very benign levels where they are, we would see them go up. That is unlikely to be the case in any of these large private sector banks. Plus the other trigger of all of them having subsidiaries, which are all doing very well as the fee income increase, which I mentioned earlier.
Do you like the power space? And which part of the value chain in power would you be most bullish on?
So in power, if you had looked at the August numbers, the August volume growth in power has been tremendous. I've never seen a YOY growth of like that in power. So some of the generating companies or transmission companies is why we would look at. So we are just invested in a transmission company. We think that's a very safe place. Plus, what happens is there's no risk of defaults, etc. And lastly, because the company also has listed InvIT, so a lot of these transmission companies could actually scale up faster, and after doing the capex and making the project live, could transfer the assets into the transmission company. So over a period from very good ROE levels, we can still see the ROE levels go up further.
Right. What about some of the renewable and solar and wind kind of names which has caught the fancy of the market quite a lot? Have you looked at them?
Sure, we have looked at them and passed them. So what's happening is that especially on the wind side, coming from a very bad base, numbers have started to look good. There have been order wins, but nobody has really been able to succeed in the 3 megawatt and above turbine size. And in the lower size, there continues to be a lot of competition. So from a low base, those numbers will likely look good, but we are not very bullish on that over medium or long term.
Viral, how would you approach pharma and chemicals? Pharma, has moved up quite a lot, but chemicals are not. Do you think worst is over for this space? Should we bought on declines from here or no?
So on chemicals, again, unlikely different companies are into different segments. But what we hear is that a lot of these Chinese chemical producers have been very aggressive in taking price cuts and pushing volumes. And we saw that or rather heard it during the commentary also from chemical company after chemical company post the Q1 results. said that they continue to see price pressure and are hopeful of the future. We don't think that sort of price competition from Chinese, especially on the bulk chemical side, is going to reduce. So even if one wants to invest in chemicals, one should be more at niche specialty chemical side of things.
Okay. What about the other global names like metals and IT? Would you look at that or you'd ignore that in terms of valuations?
So IT globally, there has been a big, Nasdaq has moved up a lot, right? Almost 45 odd percent from its lows of last year. But most of the rally has been led by AI or AI sort of related companies and recently by Tesla. So what is happening is that the service companies and to a large extent even the product companies continues to be under pressure. So in IT services, again, from a very high margin base that we saw in FY21 and FY22 due to COVID, right? The costs were down. Again, companies are trending towards their earlier margin range, and the volume growth that we saw is again sort of gone down. So maybe IT again becomes a 7-8% growth sector plus add 3 or 4% for dividend. IT again reverts back to being a 11-12% growth sector, and valuations are still for most companies are at least one standard deviation above average. So IT, we are unlikely to make disproportionate returns from this point on. Maybe a okay place to hide, but not for making great returns.